In this video, I'm going to show you how to consistently generate safe weekly passive income by selling options. We're going to talk through all the important key concepts you need to consider when selling put options. These include what strike price you should select, what expiration you should be selling your put options at, what delta should you be using, how to use technical analysis to put the odds of winning in your favor, and finally, we're going to consider a real-life trade I did that I think will help bring it all together for you. It'll help you see how you can use selling put options to generate consistent weekly and monthly income. Before I get into the details of exactly how to choose which put options you sell, let me first briefly tell you what a put option is for those of you who are brand new. When you sell a put option, you're selling someone insurance. You're giving them the right to put or to sell stock into your account at any point in time between now and the expiration day at a certain price. For example, here you see a real life trade I did in Lowe's. I sold the August 15th $200 put option. That gave someone the right to sell Lowe's to me at $200 per share at any point between now and August 15th. In order to compensate me for that risk, or to pay me for that insurance I was giving to them, they paid me $1.39 per share. So I was the put option seller and someone else bought this insurance or this put option from me. So they're allowed to put that stock into my account at $200 per share at any point in time this option is still open. Now keep in mind that although I sold it, the expiration date isn't until August, I can actually close this position out early by just reversing it, by buying to close the put option. And this brings me to my first key concept here. Most of you probably know who Lowe's is. It's a very solid building supply company. They've been around a long time. They have consistent earnings in good and bad markets. Overall, they're just a great company. I know that fundamentally they're solid, so I've chosen to add it as one of the stocks that I will trade options in or buy outright at the correct price. So the first concept here is to make sure if you're selling put options in a company, make sure it's a company that you'd be comfortable owning if the stock was put into your account. Now I know all of you don't want stock put into your account, but you kind of want to have that same mindset. Make sure it's a stable, strong, secure, safe company that you can sell put options in because you're selling someone insurance in this company. So you don't want some company that's never made a profit or it's brand new. That's not the kind of company you want to sell put options in. You want to sell put options in a company that's proven, mature, and consistently profitable over a long period of time. So basically, pick high quality companies. Another important point to keep in mind is that you want to pick companies that are not overvalued. If a company should be trading for around $200 per share and it's trading for $400 per share, do you really want to sell insurance at say $380 per share when it's $180 overvalued at that point? I don't think so. So try and pick companies that are at least fairly valued, or even better, try and pick companies that are undervalued. If you do that, then your foundation is solid. You've picked a solid company that's not overvalued. That's the kind of company I feel comfortable selling insurance or selling put options on. In order to help you pick solid companies, it'd be good to do a little research. And here you see a website called Simply Safe Dividends. And I have the details pulled up here for Lowe's. Let's just kind of look through this to let you get an idea of the kind of companies I like to trade in. So how does Lowe's stack up fundamentally? Is it really a safe company to sell put options or to sell someone insurance in? Well, let's kind of dig into it here. So first of all, we look at the dividend growth here. We said overall it's been growing its dividend. Over the past 5 years, it's been growing that dividend pretty fast at 19% per year. Over the past 20 years, that dividend has grown on average 24% a year. That's strong growth. That tells you the company's probably doing pretty good if they're willing to grow their dividend by 24% a year. And as I scroll down here, you see the annual dividends over the past 20 years. Again, we see nice dividend growth. I like that. As I scroll down a little farther, you see they have a dividend growth streak of 63 years. I really like that. 63 years has covered a lot of economic situations. During that whole time, they've paid this dividend and grown that dividend. Now let's scroll down to some more details on the financial situation. First, let's look at our price to earnings. And here we have a forward price to earnings ratio. Now, one thing I'll say here is I'd like Lowe's to be at a better deal than it is now. It's not a terrible deal right now. It's not way overvalued, but it's also not undervalued. I'd say it's fairly valued. You can kind of see that right here in this forward price to earnings ratio. This is the 5-year average of the price to earnings ratio, this black line here. Notice the 5-year average is at 17.7 and it's currently trading at 19.6. So it's a little more expensive than its past 5-year average. Now I like to look at more than just the 5-year average. I look at the 10, 15, 20, and then the maximum life of a company. But overall, you want to see it's trading around its average or even better, below its average when it comes to price to earnings ratio. Now let's go down and dig a little further into the financials. We see that earnings payout ratio kind of hovers around the 26 to 37% range, and we like that. You see here, Simply Safe is saying they prefer it to be around 60% or less, but this is great. A 37% earnings payout ratio, I like that. So that checks out. Now let's look at free cash flow. And this is an important one because it tells you how much cash they have left after paying all their bills and reinvesting into the company. This is truly how much cash they have left. And again, with Lowe's, we see nice, consistent free cash flow. And actually, the past several years, it's been a lot stronger than the previous 5 or 6 years. But notice that it has been declining over the past few years, but still it's well above its average. Then over here on the left, we see earnings per share. Again, we see nice growth, although now it appears to be leveling off. And this year, 2024, it's a slight decline from last year. That's understandable because it experienced such strong growth between 2021 and 2023. And here's a couple other factors you want to consider. Earnings per share growth. Is your company growing? Now, with a company like Lowe's, it's a very mature company. As you saw, it's been paying dividends for over 63 years. So we don't expect some high growth, and that's not really what we're looking for. We're looking to sell put options. We're looking to sell them in stable, secure, safe companies. So you see that overall, its sales are fairly consistent, although notice it is expected this year to have possible declining sales. So that's something to keep an eye on. Now we'll scroll down to a couple other important factors. Notice here in the far left, the shares outstanding in millions. And notice what's happening. Shares are going down. That means if you own stock, you're owning a larger and larger percentage of this company as the number of shares declines. So we like that. It's actually experienced a quite sharp decline in shares. Notice that back in 2015, there were 990 million shares, and this year in 2024 is not too far from half that amount. It's at 584 million shares. So overall, we like that they're not having to sell stock to pay their bills. They're actually buying stock back. And now we look at sales. A company has to have sales to survive. We see nice growth in sales, although again, we do see that it's kind of leveling off, and this year is expected to be a decline. But let me show you why that doesn't bother me too much. If you drew a line here from 2015 through present, notice the slope of this line. Ignore these 3 years right here with a big spike because of COVID. But notice that this line, it actually put us right about where we're at now. So in my opinion, even though Lowe's sales are declining this year, it's actually just returning to normal. So I feel comfortable with that. And here we see a couple other factors you might want to consider, like operating margin, free cash flow margin. If you scroll down a little bit farther, we see a couple other factors that you might want to consider. But overall, as you see, Lowe's is a solid company. It's consistently profitable, and over a long time, it consistently grows its earnings. So definitely a company I feel comfortable with. And Simply Safe is just one place you can find this information. It's not necessarily a free website. You have to pay for it. But there are other websites that you could go to, like Yahoo Finance or Seeking Alpha. So we've checked off that box that we're dealing with a good, solid, mature, consistently profitable company. Now let's dig into what put option we should sell. And here's the trade I did. I'm first going to talk to the trade that I did, and then we'll look at a possible trade we could do right now if we want to sell a put option in Lowe's right now, today. So keep in mind that back on July 9th, I sold the Lowe's August 15th $200 cash secure put option. Was that a good decision? Well, let's look at the chart. Here you see the daily chart for Lowe's on the day I entered this trade. This yellow arrow here, that's July 9th. That's the day I sold this put option. Just kind of look at what had happened with Lowe's stock price over the previous several months. Notice it reached a high back in March, about 3.5 months before I did this trade, of right at $260 per share. And then overall, it just continued to drift lower to the point where on the day that we did this trade, it was actually down around 17% from that high. Notice that previously, about a month before this, it had found support right here around this $213, $212 area. It then advanced and found resistance around this green 50 moving average. Now that actually was not a good sign. That was actually a bearish sign because as you see here, it was consistently making lower highs. But notice what happened around the time we did this trade. Notice that it tested this area multiple times. Over this week, this area was strongly tested and it held a support. So I felt pretty confident that although we were overall in a downtrend on this daily chart, that possibly the trend was reversing because it found support the same area would have found support at the end of May and beginning of June. And that support was tested for about a week and it held. But just to be safe, I did something to put the odds of winning even more in my favor. Remember what strike price I sold that put option at? It was at $200 per share. And remember when we did this trade, Lowe's was trading for around $215 per share. So as I zoom out here, you see that we had a large margin for error on this trade. Lowe's could decline by $15 per share before our $200 put option was challenged. That'd be a 7% decline. That gave me a nice buffer or a nice margin for error in case things went against me. So not only did I sell this put option below an area that had just served as support for it, but also had served as support for about a month earlier. And then it also served as support back earlier in the year multiple times. And in case that failed, there's another area of support right in here around $205 per share where it found support back at the end of last year. So I felt like I was selling this put option at a safe location even though the daily chart was looking somewhat weak. So that was my strike price. The next thing I knew is that I wanted to avoid earnings. As you see here, Lowe's is supposed to announce earnings on August 20th. Going back to the put option we sold, Notice it expired before earnings. It expired on August 15th. You see, if at all possible, I want to try to avoid selling insurance or selling a put option in a company that's about to announce earnings. Now, one question I get asked a lot is, Randy, what delta do you sell your put options at? My answer is pretty much always the same. For the most part, I don't really look at delta. I look at support and resistance as I showed you on that chart. But just one thing to keep in mind when it comes to delta. Delta does serve as a nice estimation of two things. Here we're looking at the put option chain for Lowe's that expires in about a month and a half. And here's the delta column. Now notice what delta is. So right now, Lowe's is trading for around $245 to $247 per share. The market's closed, so it's not an accurate number, but just we're in the $245 range. So if we're looking to sell the 210 put option that expires in about a month and a half, it's saying its delta is 0.073%. Well, what does that mean? Well, that's the estimation based on the stock is right now. There's a 0.73 or 7% chance this option will be in the money at expiration. Now, what that does not mean is that this option can't be touched before then. In reality, the odds this 210 cash secure put option strike price will be touched between now and expiration are higher than 7.3%. So just keep that in mind that one thing Delta tells you is the estimate based on what's happening with the stock right now at this moment, because it changes, but what the odds are this option will be in the money expiration. The other thing it tells you is about how much the value of this option will go up or down based on the next dollar that the underlying stock goes up or down. So if Lowe's goes up by $1, we expect the value of this option to go down by about 7.3 cents and vice versa. Now let's fast forward in time and look at a possible real life trade today in Lowe's. Where would I feel comfortable selling a put option in Lowe's? Well, first of all, I actually wouldn't because earnings are coming up. But let's act like that wasn't there. Let's act like there were no earnings coming up during this next option expiration cycle. Where would I sell this put option at? If I was comfortable with Lowe's current price, let's say I didn't feel like it was currently overvalued. Let's say I felt that Lowe's was fairly valued at its current price. Where would I sell a cash secure put option at? Or where would I sell someone insurance against this stock at? One thing I like that I see on this daily chart is that it recently came down and tested this area right here around 230 for support, and it held as support, and that makes sense because it was the area that served as resistance for it right in here. It was the area that served as support for it right in here. So a nice support area appears to be showing itself right here around 230. So I feel very comfortable selling a put option at, or even better, just below that 230 area. Now another possible area is right in here. Notice that it recently broke out above the high of this candlestick right in here. So it's quite possible that Lowe's is about to experience another leg up because this area here should have served as resistance for it. But to be safe, personally, I'd probably pick selling the put option right here or a little bit lower, maybe down here in the 225 area. Now I've switched back over to my broker's account. And we're looking at the option chain that expires in about 50 days from now. And again, keep in mind, we're acting like earnings are not coming up, even though with Lowe's, they actually are coming up here in about 3 weeks. So notice I've picked all the strike prices around that area, but notice there is no 225 strike price. So now it's decision time. Am I willing to sell it right at that potential support, which is around $230, or do I want to be a little bit safer and go below that at the 220 strike price? That's really a decision you have to make. Personally, with the support I saw in that chart, I'd feel comfortable selling the 230 strike price put option. And for that, we'd get around $3.40 per share to $3.75 per share, so some decent premium. And keep in mind that when you sell this insurance, when you sell this put option, you can always close it out early by buying that put option back. Again, keep in mind, this is not a trade I'm doing, and I'm definitely not suggesting you do it. And my biggest reason is that earnings are coming up. And even though it's a stable company, I prefer not to sell put options against companies that are about to announce earnings. But if earnings weren't coming up, I'd definitely consider this trade. Now let's say you want to do this more often. You didn't want to sell insurance or sell an option that expires in 50 days like the one was I just showed you. Well, you could sell a weekly option. For example, here's the option chain that expires in 8 days. I'm filming this on Thursday, August 1st, so this option chain expires next Friday. Notice if you sold that same 230 put option, you get around 35, 36 cents per share for it. And you could potentially, if the position didn't go against you, do this every week. Now, I typically prefer to sell around 30 to 60 days to expiration options, but some people like to sell weeklies, so you could also do this on a weekly basis if you chose to. One other important technical analysis tip I want to share with you is we talked about support and resistance, which to me are probably most important. But there's another area that generally tends to serve as support and resistance that you want to be aware of, and that's these moving averages. And here we're looking at the daily chart of Lowe's. And notice that this green 50 moving average tends to serve as support for it or resistance. It serves as support for it until it breaks through it, and then it serves as resistance as you see here. It serves as resistance here, and then once it broke through here, now it's turned back into support. So keep an eye not only on previous highs and lows in these waves, which I say are like the ocean, but also keep an eye on your moving averages because they do tend to turn into support and resistance points. That'll help you to pick better strike prices when you're selling your cash secure put options. Now I want to address a common mistake I see a lot of option traders making because we all want to make as much money as possible. I mean, that's reasonable. We all want that. But you want to make wise decisions, not just based on how much cash you receive up front, but based on the fact that it's a solid fundamental decision. What do I mean by that? Well, I mentioned we'd sell the 230 put option, but in reality, we get a lot more if we sold the 240 put option. So why wouldn't I sell that one? Well, although I get more premium up front, I have a lot more odds that the position might go against me. Notice that although it is trying to break out to a new higher high, that has not been confirmed yet. So it's quite possible Lowe's may come back down and our 240 put option will be in the money. And it can be hard to resist that money because notice that 240 put option, well, you get over $6 per share for that. That's compared to the $3.60 per share about that we'd get for the 230 put option. It's almost twice the money. But you just want to keep in mind that for twice the option premium you get up front, the odds of it going against you are a lot higher. So if you're comfortable with the risk, that's fine. Just understand the risk you're taking if you sell an option that's at the money or closer to the money, the one that's farther out of the money, below some solid support levels. So how can you do this in a smaller account? Well, one thing you can do is to pick lower price stocks. That is one alternative. But another thing you could consider doing is doing what's called spreads. Instead of just selling a put option here, you can then buy yourself insurance a little bit below that. Here's a perfect example of it in a smaller option trading account that I share with my Patreons. Notice that back in June, we did a spread. We sold to open 2 of the IWM August 16th 190 puts. We then capped our potential loss, or we bought ourselves some insurance by buying that same expiration date, and that's important, 186 put. So if you do the math, what do we have at risk? We sold the 190 put option, but we bought the 186 put option for protection. So we really only had $4 at risk if everything went against us. That doesn't even include the 53 cents per share we received for doing this trade. So overall, we had $4 per share at risk. Remember, we did 2 contracts, which is 200 shares worth. So in all, we had $800 at risk, minus the approximately $106 we received up front for these 2 contracts. That's a way of limiting your risk, doing the same type of strategy, but being able to do it in a smaller account. Now, if you do this, I'd encourage you to don't use all your money to do spreads. Use a small percentage and only open a new position once you close out a previous one. As you see here, that's exactly what we did about a month later on July 16th. We closed out the August options and rolled them out to September again for a nice credit of around 52 cents per share. This is a technique you can use in your small account as well as your large account. And one nice thing about an ETF like IWM is that you don't have to worry about earnings. This is a huge basket of stocks, so there's no consideration of earnings. This is actually a trade you can just do ongoingly because you don't have to worry about getting caught in an earnings announcement. So how should you manage a position like this? Well, there's a couple of strategies you could use. One is if you sell a put option that goes against you, you don't mind owning the stock, well, let the option be assigned to you. Then you can either own the stock, and if it's a dividend stock, begin collecting the dividend, or you can turn it into a covered call. Or another way to manage a position is to close it out if it goes against you. Well, how would that work? Well, going back to our trade we did here in June, notice that we received 53 cents per share for this. So for example, my stop loss, or the time that I would close this position out for a loss, is if it reached a loss of twice what I received. So if the loss amounted to about $1.06 per share, at that point, I'm gonna go ahead and get out of it. You have to decide how much you're willing to lose when a position goes against you because you will have positions that go against you. So you want to plan what you're going to do ahead of time so your emotions don't cause you to make a bad decision. But what about when they go your way? If you do this right, a lot of them should go your way. Not all of them, but a lot of them will. Well, personally, I close out these positions when I've reached about 80% of my max potential profit. When I reach that point, I either roll it out or I close it out. Now let me give you 3 bonus tips that will help you to be more successful as an option trader. The first bonus tip is to watch your volume. Down here you see volume, and this white line is the 50-bar moving average. What you like to see is that on the green up days, you like the volume on those days to overall be higher. That means that buyers are more passionate or stronger than sellers are. That's what we see here with Lowe's. Notice over the past month or so, the green up days, the green candlesticks here, they correspond to nice green bars. Overall, although we do see a few red bars, most of those red bars are below this average. On the other hand, our green bars are about the average or a little above it. So that's one telltale sign that buyers are more excited about buying Lowe's than sellers are about selling it. Another concept is to only trade in companies that are in clearly defined chart patterns. What does that mean? Here you see the weekly chart of Lowe's. Notice that overall, this chart pattern is really nice. we have consistent waves here. It's almost like the waves of the ocean. The stock price goes up and it comes down, goes up and comes down. So it's not really erratic and all over the place, but it's in a nice, clearly defined upward sloping trading channel on this weekly chart. I like charts that have predictability. That helps you pick good entry spots like you see we did back here in July. And one final thought is to sell put options when the stock prices are down at the bottom of waves. Remember this yellow arrow? That's the day that I sold this put option. Yes, we are looking at the weekly chart, but this is the week I sold that option. But notice where the stock price was on this weekly time frame. It was towards the lower part of an upward sloping trading channel it had been in for a long time. So consider selling put options when stocks are the lower part of their trading channels. And one final tip here is to look at multiple time frames before you sell a put option. And here you see the 4 charts that I always look at and consider when I'm selling a put option. Now, the top left one here, that's the 1 minute chart. And I just use that to decide how urgent it is for me to get into this position. What I mean is, if the stock is in a downtrend, I'm looking to sell put option that day, I really won't be in that big of a hurry to sell that put option. However, if it's in an uptrend that day and I want to sell a put option that day, then I go ahead and sell that put option as soon as possible. The other charts I look at for good entry points are the hourly chart. Look at where is it trading in relation to its moving averages, in relation to its current wave. For example, right now with Lowe's, it's at an okay spot on this hourly chart. I'd love to see it back down in here before I sell a put option on the 237 area on this hourly chart. This is actually the least important chart of these last 3. The 2 most important ones for me are the bottom left one, which is the daily chart, and the bottom right one, the weekly chart. Now the weekly chart tells me overall which way is the tide running. Is tide coming in, when you use nautical terms here, or is tide going out? Basically, is the stock overall going up or is the stock overall going down? We see overall at Lowe's, overall it's going up right now. However, where is it at in its trading channel? Notice right now in this weekly chart that Lowe's is at the top part of the trading channel. Remember when I sold that put option, it was back in here. So I really would not like to sell this put option right in here. I'd rather the stock to be down in here. Now saying I wouldn't, but that's where I prefer to sell it at when the stock is down in the lower part of this trading channel. Then again, looking at our daily chart here, I'd be comfortable selling it around 230 because it's at an area that previously served as support for it. So consider multiple time frames when you're looking to sell a new cash secure put option. That'll help put the odds of you winning that trade more in your favor. So keep in mind the 3 important factors I share with you in this video when it comes to selling put options. Number 1, sell put options to a company that are fundamentally strong. They have a proven track record of being successful and being profitable and growing earnings over time. Number 2, sell put options when the technical analysis tells you that odds are in your favor that you're going to win those trades. Then number 3, have a way of managing your risk or knowing when you're going to close out a winner and close out a loser. If you'd like to get an alert whenever I buy stock or sell options, check out the benefits of becoming a patron down at the link in the description below. Knowing how to pick good companies or solid ETFs to sell put options in is just one piece or one important ingredient to be a successful long-term option trader. Another vital piece of information to know is how to handle positions when they go against you, and sometimes go against you in a big way. To help you see some of my favorite tips and tricks that I use to repair option and stock positions that go against me, check out the video series at the link above and the description below entitled Option Repair Strategies. Until next time, happy investing, and we'll see you again soon.